question of the day, the question before the board today for us to kind of go through is whether or not there's actually an economic slowdown in trend at the moment, or whether or not the weather that we've been seeing here is giving some data points that are a little bit aberrant. So before we get to 14, let's just rewind the tape for a second and just refresh in terms of where we're coming from. 2013 was obviously a great year for the stock market. A 30% plus year, put a smile on a lot of people's face, made a lot of money, which was great. But from an economic standpoint, it was actually a tale of 2 years last year. So it really had the first half of the year that was pretty muddled through. The same slow pace of growth we've had since the beginning of 2009. Nothing really all that radical. But the second half of the year, we did begin to pick up a little bit of momentum in the economy. And that was good to see. We ended up with if you look at the third quarter, that had about a 4% quarter for us last year. And then even the fourth quarter that got marked back down to about 2.5% growth. When you average the two of those together, it's about 3.2%. That's a little bit better than we've been seeing during most of this cycle, and that was somewhat encouraging. I think it's probably fair to say as we came into this year that most economists were looking forward and saying, 3% is about the growth rate we're looking for the U.S. economy to pick up into this year. And we thought that's a very reasonable rate for a number of reasons. There's less fiscal drag and a whole bunch of other reasons that go into it. But that seemed to be a pretty reasonable rate of growth to assume was coming our way. In fact, if you look at, as we started this year, looking at the U.S. economy, we weren't really too worried about that situation. In fact, the thing that was kind of bugging us coming into the year was what was going to happen to the economy when the Fed began to taper their quantitative easing program. And Carl's hit this, ad nauseum, sort of, across the globe. Obviously, there's been a lot of, stimulus coming from different central banks. And certainly, over the last couple of years, there's been a lot of debates as to whether or not quantitative easing and these unusual programs do anything for economic growth. Maybe it's been hard to justify, that it's really done the job as growth has been very muddled through for a long time. But I think it's also very hard to justify that, hyper liquidity in the system from the quantitative easing program hasn't been good for asset markets and asset inflation. And that's what this chart's all about. So this chart's got two lines on it. So we have the Fed balance sheet in red, and the scales over here. So we're up to $4 trillion on the U.S. balance sheet. And the blue line is the S&P 500, and this is going all the way back to 2007. So really we began to ramp up, the balance sheet of the Fed back in 2008, as things were really hitting the fan here in the U.S. And what you can see from there is a really nice, steady, high correlation between the size of the Fed balance sheet and U.S. stock prices. So we can argue all we want that maybe quantitative easing wasn't the best thing for economics, but we certainly think it's been a driving force behind asset inflation. And so we just simply said, you probably shouldn't be too sure what's to come here as the Federal Reserve begins to tap the brakes and pull liquidity out of the system. But I think the surprise that we've had so far this year is that the data that we've seen has been much softer than we would have expected. Now, don't try to read this data real quick as it's going on. I'll just explain to you real quick what we're seeing here. This is a series of data that we are watching print during February. We probably have 12 to 15 data points that just ran by. You couldn't read them. That's unintelligible, I know. But just trust me that those are data points from all walks of economics. So we had, auto sales data that just went by your face, industrial production, we had housing numbers, we had growth barometers included in there. And the whole point of the chart is that we've seen a wide range of data points over the last couple of months that are not beating analyst expectations. In fact, many of the data points that we're watching come out are far below what analysts are expecting. So, what's going on here? We're seeing, much more of a slow and soggy bunch of economic data than we would have expected. We don't have time to cover 12 or 15 or 18 data points, but let me just walk you through a couple of data points here and kind of give you a feel for some of what we're seeing. And the first thing I'll mention is just the employment markets. Now, nice to see just yesterday that for a change, we had some data actually surprise to the upside as we got a non-farm payroll number of about 175,000. That's not the greatest number in the world. We'd like to see 200,000 or above. We really think the jobs markets are picking up and getting robust. But on the other hand, it's a whole lot better than the last two numbers we had seen, which were somewhere down in the 70,000 range, and then I think we had another one for 113,000. So it was good to see that we caught a little bit of traction yesterday in that one data point. But the chart I'm showing here is actually a little bit more broad-based. This is Pinnacle's employment model. This is something that Sora Locatelli helped us create here. It actually encompasses 10 different data points that we monitor for employment. And at the moment, all you're going to want to watch here is the blue line is a composite index for us. And you can see how it's been ticking down here over the last few months. So really on a broad-based level, as you look at a lot of the data points that are out there, they've been disappointing. And you know, we certainly need to see better jobs if we want this economy to tick past the 2% model rate and into 3% growth zone. So we're going to have to watch this very closely here. You know, employment's been one of the things that's certainly been sagging at the start of the year. How about regional surveys? So again, within that grouping of unintelligible data points that you couldn't read, there were a number of growth barometers that we watch. So we watch things, there are lots of packaged indexes out there, things like the Institute for Supply Management puts out you know, indexes to tell us whether the economy is growing. And it has a lot of sub-indexes within it, things like new orders are in there, and production and employment, and those sorts of things. And the bottom line is that we've seen a wide range of surveys coming out of both the Institute for Supply Management as well as the Federal Reserve Districts. So there's probably, you know, there's a whole host of those. Philadelphia that we have right here is one of them. They come out of New York, they come out of Dallas, St. Louis, Richmond, etc. But the point here again is that really on a pretty broad-based level, most of these surveys over the last couple of months have been coming in well below expectations, implying again that growth is starting to decelerate maybe here. This particular number here, you can see actually we went from, you know, the lines on these charts here again are, you know, as the index goes up, that's better for growth. As the index goes down, it's worse for growth. So, you know, we went from a level of about 20 on this index a couple of months ago, shot all the way down to the last print, which was a -6. Meanwhile, the expectations were for a +8, so it was just a gigantic swing between expectations here. So, you know, again, another series here, a different look at data, and again, things are sagging here for the first couple of months of the year. How about housing? You know, I think housing is probably been one of the key pillars here for the U.S. economy over the last couple of years. Certainly has it. We've talked about it before here at these meetings. We write about it a lot. There's a high multiplier effect throughout the economy when housing is doing well. Well, this is one particular data point that we like as a leading indicator within the housing market. It's called the National Association of Home Builders Index. What you're looking at here is the blue bars are about 50 analysts, so we're just shy of that, and what their expectations were for the last data point that came out on this series. You can see they're somewhere between 54 and 57. Once again, going from left to right, the higher the number, the stronger the housing market is. Well, the last data point came in as a 46, which happened to be about a 9 standard deviation event, which means it was way off the charts in terms of what was expected from the analyst. In fact, I think it was the worst miss in the series of the survey, ever. So this is not a particularly good signal, and once again, it's not just this data point. We watched existing home sales, we watched building permits, we watched a whole series of housing data that are ticking the wrong way here. And I think we need housing to continue to be a support for this economy if we're going to go from that 2% level up to 3 or maybe even better than 3% growth. So again, it's somewhat concerning over the last couple of months to watch the weight of the evidence and the housing data tick the wrong way. Last thing I want to cover is energy. And we usually bring up a chart of West Texas Intermediate oil or gasoline prices because we're all familiar with going to the pump. This time we figured we'd take a different commodity here, natural gas actually in this case. And look, natural gas heats a lot of our homes, right? A lot of businesses use natural gas right now for what they're doing, so it's important for both the consumer's pocketbook as well as businesses' margins. And what you can see here is we really had a vicious spike in the price of natural gas from about the end of November last year right into the beginning of February this year. Now, some of that's retraced. This is about a 90% run, again, in the price of natural gas. So that clearly is something that's going to run through the pocketbooks of consumers. Now, nat gas is not the only piece of the energy complex that's spiked up lately. We've certainly had oil back over $100 recently. And recently, as we do pull up to the pump, I think we're running about $3.50 at the pump from a national level. So, the energy complex is a volatile place, but certainly, again, we don't like to see at the same time other data points are starting to disappoint, a little bit more pressure again on consumers and businesses from the energy complex. All right, so the interesting thing about all this stuff, of course, is that the data's looked bad for 2 months. There are some concerning things here building. It's not just one data point, it's a lot of data points. On the other hand, again, the markets have jolted up. February was a great month in the equity markets. So, what's going on here? Could this actually be a case of temporary frozenomics? We're on the cusp of spring. I think tomorrow we reset the clocks again. It's daylight saving time, right? So, I think the prevailing view actually out there in the economic community at the moment is that you've got to write this data off. That generally speaking, all of the data here is being driven by the weather. That, soon we're poised to spring back, literally, and, the data should have a little bit of a reacceleration here once that happens and we begin to thaw. And that ultimately, the market is telling you right now that the data will be better in the next quarter, and ultimately the data points will come in, the next few months and validate what the market's doing. So, first thing I'll say is, generally speaking, the weather usually, to me, is a pretty big excuse. We've heard for years, retail sales miss, and there's no big weather event, but, someone's yapping about the weather, and that's what they would contend. Generally speaking, I don't think it's a very good, there's not much legs there in terms of the weather and driving data. But this year, let's be honest, we're in the middle of a polar vortex. The polar vortex. Has anyone heard of that before this year? Certainly not me. Look, there's stats on this too. I just looked at some.
Naples looks pretty good.
Oh yeah, Naples looks good. John, how's the tan? We wish we could be in Naples this year. But the reality is, there are some stats on this as well that you can look at. We just looked at a stat the other day from the National Oceanographic Administration that has, I think, degree heating days. And basically, they put a chart out that showed that this winter has been the coldest winter in about 25 years. So while that is typically a pretty poor excuse, in my opinion, I think this year you have to admit, we've had a fair amount of storms, the weather has been aberrantly cold, that can knock supply chains offline, that can certainly wreak a little bit of havoc. I think there's probably something to this year. Not everything. There are some data points we can talk about that have nothing to do with the weather. I think by and large, you have to factor it in. Now, let's take a look at some of the data points I talked about in a negative fashion and just, take a little bit of context with those. Not every data point that we look at has disappointed over the last couple of months. And certainly there are many data points that you'll never hear about on CNBC, like they like to inflate the coverage on the employment report that's out there. They'll put 7 people on the screen. It's nonstop every month. It's the most important data point that's ever come out. That's certainly not how we feel at Pinnacle. We watch a lot of different things. I think one of the more encouraging data points for employment has been a series that comes out of the Conference Board. It doesn't get a lot of attention. It's called the Jobs Hard to Get series. And essentially, the Conference Board goes out and surveys about 5,000 people every month. And they ask them things like, is it hard to get a job? Yes or no? And people actually track this stuff. You believe it? They track this stuff and put it on charts like this. But what's interesting is, not hard to believe that back in 2008, 2009, when those people were asked, when respondents were asked if it was hard to get a job, 1 out of 2 respondents, 50%, were saying, yeah, it's really hard to get a job. But these days, that number has dropped down into the 30% range, below 30% range. And while it can have a long way to go here to really get a very healthy economy clicking, that's encouraging. And in fact, this data point has a very high correlation, if you look at it, with the unemployment rate, which is what I just overlaid in red over here. So I think the unemployment rate right now, when you hear a lot of people talk about it in the mainstream news, it gets a lot of skepticism. Right now, I think as of yesterday, it went from 6.6 back to 6.7, but it's at 6.7%, the lowest it's been in a while. The trend has been down, and most of the news that you hear is that it's very distorted because of the labor force. Right? A lot of people have dropped out of the labor force, that distorts the number. Don't buy the 6.7% number. I would say that at least this chart contends that there were a few people out there saying that maybe the labor markets are loosening up a bit, okay? That would be a very good thing going forward for employment if that's the truth. So there are some statistics that actually say under the surface, maybe the jobs numbers aren't so bad. We got to give it a little bit of a break here and see what happens over the next couple of months. Next, housing. I just went through, I told you, we have seen most of the housing data this year, and most of it has been disappointing. Not all of it. Again, I think we had the last new home sales number was a pretty good number, but by and large, it has been disappointing. So what keeps me somewhat positive in the housing market? And I think one of the biggest things that keeps me, somewhat constructive on housing is just the fact that it's still affordable. This index that you're looking at here is just called the Housing Affordability Index. It's just a combination of the prices of houses the prices of interest rate or mortgage rates out there, and median incomes. So those are really the three big inputs into the housing market. Do you have a job where you're making money, and what are the prices of the houses, and what's the prices that you can take a loan at? So what's interesting about this series again is on this one, it's hard to see here on the left, but the higher you go in this chart, it's a little bit inverted in terms of the thinking. The higher you go, the more affordable housing is. The lower you go, the less affordable housing is. So, obviously when we got to 06, we were in a bubble in housing. That line is very low. And as we got to 2011 over here and 12, man, it was cheap. What a great time to buy a house. And yes, we'll all admit that housing over the last couple of years has gone up a lot in price. It has. Last year we had interest rates, climb, just like Carl said, a fair amount. So that puts a little bit of dent in terms of housing being not quite as cheap as it was. But take a look at it versus history. I mean, the beginning of the slide starts in 1986, and through 06 over here, I think we have a shaded region. It's been a lot more expensive than this for a long period of time. So I think if you take a step back again and get a little context here, the housing market's still pretty cheap, and that ought to put a floor under housing. Next, leading indices. So I talked about those regional surveys we're watching, things like the ISOM and the Philadelphia Fed and a number of surveys that are telling us that growth is sagging a bit. I think the best news that I can tell you is that, even more important than those surveys to us are some of the leading indexes that we watch. Again, the market looks forward, not backwards, right, or not what's happening today. It wants to look forward a couple of quarters. We look at a lot of indices that tend to lead the economy, okay? This is just one of them. It's called the OECD leading indicator. But we look at a bunch of them. We look at the Conference Board's numbers. We look at the Economic Cycle Research Institute numbers. And the good news here, again, is that even though a lot of the other data is sagging here, none of these indices are cracked at all. In fact, right now, they're very stable and rising. So at the moment, the leading indices would support some credence to the fact that maybe the weather's wreaking a little havoc on some of the other numbers. And that, maybe as we get out here into the next quarter or two, maybe the markets are right, and the data is poised to spring back. Let's see, inflation. So I covered energy, and energy is obviously a part of inflation, a very volatile part of inflation. And we know that the Fed likes to strip that volatility out, look at core numbers a lot of the time. I'm going to give you two series right here. This is the Consumer Price Index in blue, right, a basket that should represent what consumers are paying. And then the Producer Price Index in red. Again, that's a good proxy, again, for corporations and what their costs and their input costs are. And so, my point here would be, yes, we've just had some volatile inputs to energy. So we have had some weather events lately. Cold typically will make some of the energy complex go up. We've also had some geopolitical events. And it doesn't help when, Russia's in the news and natural gas is on the line either. So, those two things are certainly simmering out there. But if you look at inflation across the board in the U.S., and it doesn't matter what indicator you look at, inflation is still really low. These two measures are here, they're sitting about 1.5%. Not on here is the Fed's preferred measure called the Personal Consumption and Expenditures Deflator. That number is running about 1.1% at the moment. So inflation at the moment is still very low, and that should still support consumers' pocketbooks. It should still be supportive of margins for businesses. So, don't be so worried so fast about a little bit of volatility in the energy markets. And the last chart I have here is just on the Fed. So again, I started by saying we came into the year with some anxieties about what's going to happen as the Fed ends the experimental medicine, in the quantitative easing program. And, that's an ongoing project here. We're not sure what's going to happen by the end of the year. But once again, I think you need to have some context. The Fed is not, slamming on the brakes in terms of what they're doing. In fact, if you look at what's happening right now, the Fed's being very incremental in reducing the accommodation that they have. So, we've gone from 85 billion of bond purchases a month. At this point, we've decided 65 billion is better. And as long as the economy is good, the plan is to very slowly ratchet this down. At the same time, remember that we're running 0% interest rate policy here in the U.S. So, here it is, the Fed funds rate on this particular chart. You can see just pegged here at 0 since 2008. And a lot of the markets last year really began to riot. The taper tantrum last year occurred mostly when investors began to anticipate that this level, the Fed funds rate, was going to start to diverge and go up. Since then, that's come off the boil. I think expectations are for the funds rate to not move for the next year or so. We'll have to see. But even when funds rate starts to move up, as long as the economy's doing okay, that doesn't have to be catastrophic either. I mean, reality is, if we go back to this line right here back in 04, this is the time where rates started to get raised from 1% levels, and they went from 1 to 5. And during the next couple of years, the markets rallied 40% because the economics supported the fact that the rates were going up. So I think the bottom line here is the Fed is still pretty easy. They're tapping the brakes right now. And the most important thing here is I think Janet Yellen is continuing the policies of Ben Bernanke. In other words, she's going to be very data dependent. So to the extent that we continue to see bad data come out, like we have seen the last couple of months, there's no question in my mind that the Fed, they won't hesitate to shift back into a mode here where they'll be easing again. So they could easily taper the taper or just stop removing accommodation if they would like to do so. All right, so that's it. So let's cover this. What's the verdict again here? First of all, I think the weather is probably having a material impact, even though it's usually you don't rely on the weather. It probably is having a pretty adverse impact. No, not every data point is being affected. We know that. But I think we have to give the momentum that the economy had built the benefit of the doubt, at least for the next couple of months, and see what happens as things thaw. Fed tapering, it's still an ongoing question mark, right? What's going to happen by the end of the year when we go from 85 billion to nothing? Again, with context here, I think as long as the economic data points continue to come back in and start to confirm that the cycle's okay, I think the market might be okay with that, But it's an experiment, and it's something that we don't want to be too aggressive either right now at the time we know liquidity is being withdrawn. That is somewhat of an experiment. So lastly, at the end of the day, I think you see kind of a foggy picture. I mean, it's the theme of this thing, peering through the fog here. Clearly, in the U.S. data space, when we're evaluating the business cycle, it's a foggy situation, which would, to us, it just means we don't have a whole lot of conviction here. We're going to have to watch a little more and see how things play out and adjust from there.